insight on where the markets could go from here, let's go to our featured guest of the morning. He's Patrick Horan, Principal and Portfolio Manager at Agilith Capital. First of all, Patrick, thank you for joining us. Always great to have you here.
Always good to be on the show with you, Paul.
So what do you think of these markets that have really surged higher?
I think this is kind of what consensus has been talking about, and I don't typically try to agree with consensus, but I'm in the camp that I do think we are in for very strong equity markets. There's some nuances probably where I would disagree with the performance over the last quarter, but for the most part, what we see is a strong economy. I think we are in the middle of a paradigm shift, which is just early in being understood, to a much higher, a more robust economy, higher productivity, and slightly elevated inflation. And that all speaks really well for equities and not so much for bonds. Bonds are still really held really well in portfolios. And I do think the selling of those bonds will be the benefactor of equities going forward.
Will we see a broadening out of leadership in the markets? We've seen Apple come off, we've seen Tesla come off in a big way. So the Magnificent Seven, there's two members who are now underperforming. Is that a reflection of a greater breadth in the market?
I do think so. I think that's what this market needs, and not only is it affecting the S&P in terms of. In fact, there'll be some stuff later on in the show that we'll go through, but I do think we're starting to broaden out in the S&P. I see performance in the TSX, certainly around the small and mid cap stocks, really strong. And the other interesting thing is I'm seeing the Magnificent Seven or whatever, the 12 or whatever you want to call them. I see a lot of volatility in their names over this past quarter, which is very unusual for leadership. And to me, it's a telling sign that there is shares being exchanged, and there is a different way of thinking. Volatility at tops and bottoms usually signal a directional change in the market, and so we're believers. The market broadens out. We're seeing it. We're seeing Japan breakout, Germany breakout, France breakout. Canada's probably about to break out, and you have to ask yourself if. Why would you hold a really expensive stock with a lot of downside from evaluation risk when everything else is performing well?
I believe we've got a graph here that you provided with us that deals with the S&P 500 on an equal weight basis, not the S&P 500 that we're very familiar with, but the S&P 500 where each of the 500 stocks has an equal footprint in the index. What is this telling us? Let's first identify the white line and the blue line. What are those lines?
So the white line is the S&P S&P cap weight versus the equal weight. So basically, from a market cap perspective, how is the average stock doing versus the actual index, which is more cap weighted or market weighted. And the bottom, the blue line, represents the rolling average of returns from that perspective. So basically, on a continual basis, which has outperformed the other from an annualized 1 year standpoint. So basically, it gives you kind of a rolling, long-term rolling average. And the reason why I wanted to show this graph is because you can see where we're at right now, and it looks, from my eyeballs anyway, it's about minus 15% rolling return. So basically, literally, the cap weight has outperformed the equal weight by about 15% over the past year. That has only happened 2 other times, going back to 1960.
Looking at the low points of that blue line.
Correct. And they were inflection points for equal weight to eventually outperform cap weight. We are starting to see that from a short-term signaling standpoint right now. January was a very concentrated month. February was a broadening out month, and it continued to broaden out in March. And so we're believers that you have to be really selective here about what you're going to go into. You don't want cap weighted. You want equal weighted. In fact, you want to go to the other side. You want to be in really small caps. The Russell 2000 to me looks the best. So if you can get to these smaller companies, mid-sized companies that benefit from inflation trends and productivity growth, that's where you want to be. So I wouldn't be looking at your typical very stable dividend stocks. I wouldn't be looking at the growth stocks that have done so well. I'd be looking at that middle group, and that's really what a lot of people call a stock pickers market. And we think that's going to be, we're going to see that over the next, like, say, 3 to 5 years. Because the cap weights, or sorry, the market weights are so expensive, they have been bought up, and they're so well owned. And that, the great saying is, when everyone owns them, who's left to buy them? So.